Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategy Officer here at OptionsPlay, and with me again is Jessica Inskip, our Director of Education and Product. And we're here to talk about a topic that we don't cover very often when we talk about option strategies, which is what happens around exercise and assignment and how to understand the risks with regards to exercise and assignment. There are many myths around this and a lot of questions that we get. So today we want to really frame up exactly what happens around exercise, exactly how options are assigned, and hopefully help answer a lot of the questions that you may have regarding specific options, and also dive into some of the option strategies so that you can help manage and avoid some of the exercise and assignment risks that we'll discuss here today. So with that, what I'll do is I'll hand this to Jessica to kick this off. I will be joining her throughout the session to kind of provide some thoughts, and then I will come back here towards the end to discuss some of the rules that we have in place, again, to avoid assignment and exercise and assignment risk, and show you the ways that we help you understand how we trade options and manage our positions as we get closer to expiration. With that, Jessica, I'll hand this off to you.
Thank you, Tony. So excited to dive into this one. I know there is a lot of instances and one-off circumstances, and we're going to touch on some of those. And I'll also give you some of the intricate details that your broker may take and things for you to be aware of just as we cover this topic. So if you have any questions along the way or you run into a scenario, I'm okay if you pop those in the chat, but of course we'll have more detailed Q&A at the end. So as always, starting with that important disclaimer, types of securities forms and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by OptionsPlay or a solicitation or an offer to buy or sell any securities. And this video is not intended to be used for individual tax, legal, or investment planning advice. So what we're going to cover today, we'll start with reviewing an option. So it's a slide you've probably seen before, just going through the components of an option. It's important with the exercise and assignment process, the types of options, so the various, and as that varies with exercise and assignment. Then we'll go through the bulk of it, which is the assignment process. And then I'll hand it over to Tony, where he'll give you everything that you need to know, inclusive of managing your trades and really the good details of how we help you through this process. And of course, save time for Q&A. But the main question that we're really going to answer, aside from the tools and resources, is how does the options exercise and assignment process impact me as a trader? What do I need to know? What do I need to know about my brokerage firm? What are the things I need to be aware of around exercise and assignment? So starting with what an option is, something that you all probably know or have seen before, but it is essentially a contract between a buyer and a seller. It's a contract that's executable at any time in the case of American style options, which we'll go through in a brief moment, with an expiration date attached and a price attached. So it essentially represents you're able to buy or sell a security at a specified price within a specified time frame. The seller is receiving a premium, the buyer is giving a premium in exchange for that contract, in which case the buyer owns the rights to that contract. They are the ones who own it, so they can execute upon the terms of the contract. And then the seller has the obligation to fulfill that contract. So depending on what side you are, depends how exercise and assignment really affects you. So if you're the buyer, since you can execute upon the terms of the contract, you're the one who can initiate the exercise. You're controlling that. And that's a really important part when we talk about, am I likely to be assigned, or looking at that from the seller's end? You have to look at it from the buyer's point of view, because they are the ones that are initiating the exercise. So that's extremely important. The seller is just obligated to fulfill those terms. So in the case of a call, they're required to sell the shares. And in the case of the put, they're required to buy the shares. So something you haven't heard before, but just wanted to make sure that we cover that. And this you have seen before, but it's just a helpful chart just to understand the obligations and then the bullish and bearish components of those individual contract legs. So if you are a buyer, you own the right So in the case of a call, you own the right to buy. For a put, own the right to sell. And then sellers or short options holders have the obligation. The calls have the obligation to sell, and the puts have the obligation to buy. And I do love this chart, and I will probably show it almost with every presentation that we put together, but it's very helpful just on those 4 individual legs and building upon them and just remembering the obligations and where they fall and drivers and scenarios. So make sure you have this one memorized. All right. So I touched on this a little bit earlier, but something we haven't brought up, at least within this series, is American versus European options. And this really determines I'm going to call it the fine print of the contract. How are your terms executable? So if it's American style, that means it can be exercised at any time and they are physically settled. So you're going to physically receive shares of a security or physically sell shares of a security. So there is some type of asset that is settled between the buyer and the seller. European style, they are only exercised during a specified time frame. So if you are a holder or the long holder of a European style contract, which is generally indexes, so think of things like that, you can only exercise those in a certain time frame. Normally it's the day of expiration or the day before, depending on the type of settlement that's there. And they're normally cash settled. So the good way I like to think about that is if you can't purchase an index, the option still contains the right to buy the index. But if you were to physically receive all 500 shares in the S&P 500, that is going to be absolutely ridiculous and hard to accomplish. So therefore they are cash settled and you have a settlement value that's determined, and that's the way that you exercise or the contracts are settled. With European style though, there are a lot of little intricacies and details, and we'll have another webinar that goes through index options, but it's important just to know a few components for this presentation today is the different settlement values. So some are issued on weekly basis or a monthly basis. SPX has different expiration days. So there could be some that are on Fridays, there could be some that are on Wednesdays. So it's important to pay attention to that. But even in addition to that is the settlement values. So essentially, if you may not have to look at the actual underlying security to determine if it's in the money or not. Sometimes there are settlement indexes. VIX comes to mind immediately. That one doesn't utilize VIX if it's BTO, but you have to look up a specific symbol and there's a settlement value that's determined. And then that will determine if your option is in the money or not and what credit or debit you'll receive depending on what side of the option you are. So in addition to that, I do have a couple of examples just to drive home that different styles. Love my examples there. So I just used a long equity call utilizing SPY and SPX. So just the variance of cash settled versus actually physical shares settled. So both of these are in the money by $10. One is just the index, the other is the underlying security. We're assuming that this is expiration here. So since they're in the money by $10, remember a call represents the right to buy. So if the right to buy at 430, SPY is at 440, it has to be worth at least $10. The market's gonna price intrinsic value on the day of expiration. So that's where it's coming from. However, if I did want to execute upon the terms of this contract, which I can do as the long equity holder, it's my choice, I could purchase 100 shares of SPY at the strike price, $430 per share, which will result in a $10 gain, which is also what I could sell it on the market for, which we'll talk about a little more detail. The long index call though works relatively similar. You just don't physically receive the shares. You're credited to your account the amount at which you essentially gained, but it's the amount that you're in the money. So in this case, it would be $10 a share or $1,000 that you would receive in your account on expiration day because SPX or an index option was in the money. So there isn't any shares that were transacted, but rather cash. And then the other component just to watch out for, you may see this on an options chain, is AM settled and PM settled. All that means is AM settled options, their settlement is determined on opening prices. Those carry overnight risk. So if I have an index option that expires on Wednesday and it's AM settled Thursday, overnight Wednesday, there could be something that will happen that will cause that option to move up or down, but the settlement value is not determined until the opening prices. So there's some overnight risk there. There's only a couple of options that fall under that category. And then PM settled options are determined on closing prices, which is the same day and something that we're all a little more familiar with. That is an important component. So I would love to know if you grasped that. So if you don't mind, just in the chat window, type a 1 for me if you understood that. Really what I want you to drive home is the difference between cash settlement and credits and bringing in securities.
And while everyone answers 1, which I see a lot of, just to reiterate, when we do, you've seen me do quite a bit of education on some index options, specifically the NASDAQ 100 index options series. Those are all European style index options, meaning those are all cash settled. They remove what's called assignment risk, which is something that Jess will discuss here in a little bit. And that AM versus PM settlement is really what throws a lot of traders off when you're looking at that options chain. I encourage most retail traders to only trade PM settled options. It's exactly the same way as your stock and ETF options. They expire on the close of Friday. It's based on the closing price on Friday that determines whether you're in the money and how much you potentially make or lose. Versus an AM settlement option is really, in my opinion, not something that you want to hold on to through expiration, because as Jess said, you cease trading the night before, but you don't know where it's going to open the next day, which is actually where the settlement value is determined off of. And that's something that overnight risk, a lot can happen these days overnight. And you don't necessarily want to take on that risk overnight and not have the ability to close out a trade prior to knowing where the market is going to open. So just be careful with those things. And I'm glad that Jess is showing these things to you for those of you that are new to these types of AM versus PM assignments.
Mm-hmm. And I do see a lot of questions coming in. Where do I see if it's AM or PM? It honestly varies broker to broker, but most of them are going to have them directly on the options chain next to the expiration. So when it goes down, it should be right at the top. It's close to the expiration somewhere. It's normally within that series.
And just to clarify, if you don't see anything, that's usually a PM settled option, because 99.9% of option contracts are PM settled. AM versus PM, generally speaking, is only for European index options. So you have a few index options, specifically SPX, NDX. These are the ones that come to mind that have both AM and PM settlement. And there's usually a marker for AM settlement. Anything that doesn't have a marker tells you that it by default is a PM settled option.
Mm-hmm. So only worry if it's index, but stocks or ETFs, American style, you're fine. All right. So the assignment process. So put together a little illustration just to go over exactly what happens in assignment. And this really helps visualize, but understand some of the risks that are involved with it that we're going to go through. But remember, as a long option holder, regardless of a call or put, you are the only one that can submit the exercise instructions. It is up to you. You are the one that submits it. You submit it to your broker by some way, shape, or form. Some allow them online, others you are required to call. There's a lot of variances of how that submission is there, but nonetheless, you give it to your broker. The broker then sends notice to the OCC, the Options Clearing Corp. Their job is to keep a fair and equitable market. So they're the ones that are going to clear the options themselves, but also the settlement and assignment process. So they're really an important component of options altogether. The OCC then randomly assigns a broker that is short that same long option contract that was submitted for exercise. And then your broker, either randomly or by a first in, first off basis, will assign someone in their firm who is short that subsequent contract. And those are little rules. It's something that happens automatically. This is an overnight process. The only thing that you're involved with is you're either on one end of the spectrum. You're the person who submitted the exercise, or you're person on the short options writer who was notified of the exercise. But normally you don't know about this until the following business day due to that settlement process that's there. So in order to know if you are that person who was randomly or assigned via FIFO, you have to look at it through the eyes of the person who is submitting and controlling and starting this process, which is the long options holder. I mean, a little fact doesn't really, I think, help change anything, but the brokers are required to either have FIFO or random, and they can't change it. It's something they have to have on file of a specified process of the way that they handle assignment. So if you ever want to know how that is, you can just ask your broker. Normally it's posted online, or you can give them a call and they'll have it. So
I think this is a good time to ask a question, a knowledge poll. And the question is, and what percentage of options do you think are actually exercised? Meaning, if you're a long call or put holder, what percentage of those calls or puts are actually exercised? Wow. The numbers are pretty heavily skewed towards 5 to 10%. Almost 64% of you say 5 to 10%, a quarter of you say 10 to 25%, and the numbers above 25% are pretty low. With 2/3 of you answering, I think that's a pretty resounding answer here by the group. 64% of you say 5 to 10%. And Jess, I think you can share with them the correct answer.
Yeah. So here's your key statistics. 7% of options are actually exercised. And these are really great statistics that help you understand if you're first trading options or just the components really around it with those weird anomalies that happen with pricing. Options are mostly traded out of the market because they are, once they hit expiration, they are only going to be priced in with intrinsic value unless there's something very odd happening. So what that means is the actual value that you exercise should be relatively equivalent to exactly what you can trade it for on the market. However, because it only trades in intrinsic value on the day of expiration, anything that's outside of that or very far out of the money becomes really illiquid, really difficult to close. And that's why it's extremely important to have exit strategies so you can maintain that liquidity or capitalize on that extrinsic value. There are lots of reasons behind that, but for the key of showing you these statistics really is how most options are traded out of the market, and you can utilize that as having a really good exit strategy so you can make sure you capitalize on the liquidity that's there when extrinsic value is still present. And 23% of options actually expire worthless. And keep in mind with this, that may be your goal. You may want it to expire worthless, so that shouldn't be too much of an alarming statistic. But these are interesting. I grabbed these from the OCC website yesterday, so they're pretty up to date.
Yeah, and just to clarify, when we say traded out of the market, that means an option that prior to expiration was closed. Whether it was in or out of the money, it was closed before the actual expiration date. So I think this is also a good time for us to do a second poll. And I just want to get a sense for what your understanding is of that assignment process. So here is in a scenario, you've sold a $100 call option. Whether this is a cover call or a naked call or part of a spread, that doesn't matter. But if the stock is trading at $105 and there's still 3 weeks left to expiration, are you at risk of immediate assignment? So this is actually surprising. The answers are fairly split, almost evenly split between yes and no. Again, with about 2/3 of you that have answered, I think that's a pretty good sample size here. 47% of you say yes, 48% of you say no, and 5% of you say, I'm not sure. This is where the answer is technically Yes, but most likely the answer is no. Meaning the chances of you having being at risk of immediate assignment is very close to zero, actually, especially when we're talking about 3 weeks left to expiration. As you get closer to expiration, or if the stock pays a very, very large dividend from a dollar amount perspective, you do have an elevated risk of early assignment, but still the risk of early assignment is relatively low, because the reason for this is because for that $100 call buyer to exercise early, they would lose out on all of the extrinsic value of the option. They can actually make more money just simply selling the option than they can exercising an option. And that's why, economically speaking, it doesn't make sense to exercise early, especially with 3 weeks left to expiration. There's a lot of time value still left with 3 weeks left to expiration. So if you are a call buyer and you still have 3 weeks left to expiration, don't exercise that call option, even if you're profitable, thinking that, oh, I'm going to be able to lock in a profit. You will make a bigger profit if you simply just sold that call option rather than exercising that call option. So hopefully that helps dispel some myths around, especially since 47% of you answered you think that there's a risk of immediate assignment risk. The answer is that assignment risk is actually fairly low until you get very close to expiration. The last day or two, that early assignment risk is relatively low.
Well said. All right. So want to talk about what happens the day of expiration. So now we're on expiration and you're a long option holder. I've got the example of a call, but utilizing in the money, near the money, or out of the money. You can think of it in relative terms with a put as well. What's important to know here, and what I want you to understand, is what your firm will do too. So this may be something that you may be surprised by, or things that happen, or you find out the hard way when it happens to you. So that's why it's important to know what to do when you actually hold these options at any time. And when the way I have this laid out, it means held in your account period, whether it's in a multi-leg strategy or individually on their own. So if you hold an in the money option at all, what you can do on expiration is you can sell it to close. I've got the example of 105, but you can sell it to close for its intrinsic value or relatively near to. You can have the option to exercise it and submit exercise instructions if you want to own that security. If you do that, know that your profit loss is going to change. There are different tax consequences that are involved. You have to have the capital that's available, and then you've got to submit those instructions. Your other alternative is if you want to close, you do intend to close your option, you don't have the cash available to support the exercise. So in this case, you can't afford to buy the 100 shares, or you have it tied up with another investment. You can submit what's called a do not exercise to your broker. And what that does is that if you don't have enough cash in your account, the broker is not going to allow you to initiate that exercise. And one point that I failed to call in the beginning is on the day of expiration, any option that is in the money by 1 cent or more normally experiences auto exercise and assignment. So if you're walking away and you don't have to initiate the exercise, it's the way the OCC makes sure that you actually capitalize on the value that that contract contains. And the only way that you can stop that at an auto exercise is by submitting what's called a do not exercise, or in shortened form, it's often called a D&E. When you do that, you take the liability off your broker and you put it on yourself, and you say, I know that if I don't close out this option, I'm going to lose a lot of money, which in this case would be $5 if it remains at 105. But I think ABC is going to go up a little more. I'm going to close out this option before market close. And they'll say, okay, I'm going to submit do not exercise instructions. Those will go through. And that means if you don't close out your option and ABC was at 105, you lost $500, but you've said that that's okay. So that's your option as a long call holder that you can take if something's in the money and you intend to close it on expiration day. What your firm will do is sometimes try to get a hold of you, sometimes not, depending on the volatile day. So if it's something that a lot of people are trading and it's highly volatile, probably Twitter is a great example of that right now, they'll submit a D&E on your behalf or close out the options. So that's something what's really important to know is anytime you have an option that's in the money on expiration day, do not assume that auto exercise will occur. Do not assume that you're going to capitalize on that. You should definitely try to close out those options if you can and have a really great exit strategy. And that really leads into the tail end of the conversation of how to really define that. But that's a really important component anytime you have an option. That risk is still heightened if you have a near the money option, because ABC could go above or below your strike by the end of the day. And remember, it just has to be at 105.01 for that auto exercise to occur, or if you're on the short side for the auto assignment or subsequent assignment. You could attempt to close it. You probably could, because it's near the money. There should be a little bit of a market for it. You could exercise, wouldn't make sense, but you could. Just wanted to lay out what you could do. And you could also submit a do not exercise. But in that case, in all three cases, your firm can and may, not guaranteed, do any of these on your behalf. And the important part for you to know about that is that could cause you to lose out on some value, but the purpose of it is to protect you from having a negative balance in an account that can't support something, like even a retirement account or something of that nature. So just know your options going into expiration. But the important part that I want you to take away from looking at this, the perspective of a long option holder, is closing out your options is always the best case scenario, because you are making sure that you capitalize on your gains and you realize your gains.
And we're gonna remember this concept of your broker could potentially submit a do not exercise on your behalf, especially when you think about spreads. We're going to talk a little bit about some spread scenarios and what could happen if you end up in between the two strikes of a spread and you may not have enough capital to actually be exercised, if you will, on one of these long legs. So that's something to consider. We're going to come back to this concept. Make sure that you remember this when we discuss that in a few seconds.
Absolutely. All right, so short options, same thing here, but you've got a little bit of differences. So you have an obligation, so you cannot submit any exercise instructions, so that's taken away. Now you're not in control of the scenario, you're on the other end of it, but you can look at the driver's side and understand if it's possible. So if you hold an in the money option, so the 100 strike price call when ABC is at 105, you know you're going to get a cent. So your only options here are to remove risk from the table, which is the only way that you know you will not get assigned, is by buying to close those options, or allow assignment if your account can support it. If from the account supporting perspective for your broker, if it's a covered call, that'll be fine. You own the underlying shares. That means your account can support it. If you have a margin account and you want to short the shares, you have to make sure that you've got the margin buying power available and those shares are shortable. So that there's a lot of other instances that go there, and then you're retaining that unlimited risk profile. So really what your broker is going to do in all of these scenarios are really the near the money and in the money is, if you can't support that assignment, they're going to close out your options for you. And mind you, they normally don't do it right before market closes or try to do it really early in the day, depending on what the market's doing. So you could get closed out around 2, you could get closed out around 1. It's really unknown, but that's important for you to know as a short option holder. That's why that exit strategy is extremely important. But having an in the money option on expiration Friday is increased risk. And that goes along, like Tony was saying, with the multi-leg transactions. It's extremely and ever so important on that side. The near the money options, this is where it gets really interesting, and we'll go through that a little bit deeper, is going through the OCC cutoff times where you think you're out, but you're not. So it's important to make sure that you watch near the money options and try to close those as well, because exercise instructions can still be submitted up to 5:30 Eastern time. So even if the market's closed and you think you're not at risk of assignment, you actually could, and we'll go through that in a little bit deeper. But in all of those scenarios, just understand the risks involved. You can allow them to be assigned as long as you can support it, or expire if it's out of the money. Anything you want to add to that one, Tony?
No, I think you've got that really well covered.
All right. So on to the broken spread assignment. So use just the similar ABC 105 and the 100. It's just easier math there. But this is a scenario that came up and sometimes even made the news. So I think it's important to talk about this and what happens. So whenever you have a spread, you create an offsetting position. So if I have in the bull put scenario, the obligation to buy at 110, that's a bullish strategy. I want to keep the credit that I'm receiving for this. However, I have the long equity put. So I have, in case the stock goes down against where I am, I have to buy at 110. If it goes down all the way to 0, that's where my max loss is. Let me cap or limit my max loss by giving myself a predefined sell point of 100 if it does go down. So it's a risk mitigation tool. However, in this case, the underlying is in between the spread in both scenarios. So on that bull put spread scenario, the long put would be difficult to close because it's going to be out of the money by $5. So therefore, there isn't a lot of, there isn't any extrinsic value. There is 0 intrinsic value. Somebody has to take the other side of that trade. Cabinet orders never really work. So it's going to be really difficult to close that option. So that's an important part of it. Your short equity put is going to be assigned. So you probably have about $10 or $1,000 set aside as your margin requirement for this trade. It's going to cost a lot more than that for you to actually buy the shares. So this is where the short put will be assigned in this scenario. And it's very possible that your broker is going to try to buy to close that short option in this scenario. So you just have to pay attention to what is happening here. And the same thing with the bull call spread. So it's just your obligation kicks in, or that auto exercise will kick in when your option is in the money. So in this case, the long equity call is in the money. So it's risk of auto exercise. It's very possible that your broker would put in a do not exercise there or something of that nature. Wouldn't make sense because it'd almost leave you naked in a way. But that's why these types of strategies are really important to have your predefined exit points to avoid these type of situations. I never want to be in any type of these situations on expiration day. It's just a lot to manage and a lot to figure out, especially if you're trading something near the money with a shorter term expiration, then this likelihood of this happening is ever so high.
Yeah, and whenever you're trading any type of spreads, one, we generally manage these before expiration, but if you do find yourself in a position where you have a debit or a credit spread and you're entering, let's say the last day of expiration and the stock is in between the two strike prices, that's when this risk becomes elevated, and that's where this risk becomes true. So be very careful. Jess, what I think this is a good time for me to actually jump in and discuss a little bit about kind of managing these debit and credit spreads. I'm actually going to take over the screen sharing. I'll give back the screen sharing back to you in a second. But what I'll do is I want to discuss a little bit about if you are trading a debit or credit spread, what are the rules that we have in place to help you manage these trades prior to expiration? And these rules that we have in place are not only best practices to help you maximize your potential profits, but also minimize losses. But more importantly, it's also all designed to help you avoid exercise and assignment risk. So when we talk about a debit spread, and this applies to even just long calls and puts, which are debit trades as well, the rule of thumb is that you should exit the trades based on one of two possible triggers. Whichever one triggers first, that is the rule to get out of the trade. So either the stock, the spread or the call or put that you've traded has lost 50% of the premium that you have paid. If it's a spread, it's the net premium that you have paid, or start taking profits if you've made at least 75 to 100% of the premium paid. Now, this is the rule of thumb that we have in place for those of you that follow our daily place trades in terms of managing risk. If you're trading more than one contract, this is an opportunity to close at least half of your position. If you're trading a single contract, I recommend that you close out your entire position upon one of these two rules. So if we use an example here where we buy a 100-120 call spread for a net debit for $10 here. So the 110-120 call spread for a net debit of $10 That means I've paid $10 for this spread. My maximum risk is the $10 per share or $1,000 a contract. So what I want to do is I want to either take profits when the spread is trading from $17.50 to $20 in terms of 100% of gain, or if the spread that I paid $10 for is now trading at half its value at $5, that's a rule for me to start taking losses or start cutting losses on this particular trade. So those are the two rules that you should generally have in place. Now you can change these percentages a little bit. These are the percentages that we use. You might use a slightly different one. The rule of thumb here is to pick a specific rule and stick to it day in and day out. If you do so, you're going to be able to take profits when the trade starts to go in your favor. You're going to cut losses, meaning not find yourself in a position where you're holding a trade towards expiration, where it's perhaps even getting down to $0 in terms of the spread, and you're opening yourself up to assignment and exercise risk. You can avoid all of that by following these two very simple rules of when to take profit and cut losses on a debit spread. And I just want to quickly cover if you are short a credit spread. The credit spreads gets a little bit more intricate in terms of the rules. You have 3 possible triggers to exit a credit spread: either at a loss when you've triggered a stop loss, either at a gain if you've made a profit, and there's also a time-based rule to exit your trade on a credit spread. For those of you that want to learn more about this, I dive into why these rules are in place. For those of you that follow our education here on credit spreads, and Jess and I will be doing some education here on credit spreads as well. But in the same example here, if I sold a $20 wide credit spread for a net credit of $8, the rule of thumb is that once the $8 spread decreases down to $4, I've now made 50% of my max gain. It's time to start taking at least partial profits. If you traded one contract, take full profits. And if the $8 credit that I've collected on the credit spread is now trading at $16, now I've lost 100% of my max gain. So I've lost $8, which is the max gain that I can potentially make. It's time to cut your losses and move on to the next trade. So those are the rules that we have in place. And lastly, if let's say it reaches 21 days to expiration and it has not triggered either a take profit or a stop loss, that is also a time to consider getting out of the trade. Now, this is more so from a gamma risk perspective than an assignment and exercise risk perspective, but it serves both purposes. It helps you avoid the gamma risk that you get into the last 3 weeks, but it also helps you avoid assignment and exercise risk, especially if the stock is in between the 2 strike prices as you approach expiration. And just to illustrate this even further, when you follow our trading research, the daily play research that we send out, such as the Eli Lilly spread that we initiated this morning, this was a credit spread. We do a fairly good mixture of debit and credit spreads. Not only do we tell you the exact strategy, the expiration, the strike prices, and the premium, we also show you the number of contracts that we trade. And this is designed to help you better understand how to position and size these for your portfolios. And Rick and I are actually doing a session tomorrow morning at 8:45 a.m. I hope many of you will be able to join me on that session, where we're going to dive into why we use these specific rules for our daily play. Not only are you going to see how many contracts do we open up for each individual trade, but you're also going to see how many contracts we close for each given trade. This is designed so that you can really understand how to apply these rules that I just spoke to you about right now in terms of when to take profits and when to cut losses. We took a short trade on Match, recently reached that threshold of 100% gain on a debit spread, and this is a time for us to take profits and move on to the next trade. And we actually closed out half the position earlier, and we're now closing the other remaining half here right now. So this is really a good illustration of rules that can help you avoid some of these assignment and exercise risks that Jess is showing you. And more importantly, we actually show you how we do it based on the research that we put out with every trade that's included in the daily play. So with that, what I'll do is I'll turn this back to Jess, because she has a few more scenarios that she wants to walk you through to explain further risks that you have around exercise assignment that you should be aware of, because these are some of the things that have caught out some other traders. And it's important for you to understand how to potentially avoid these same scenarios for yourself.
All right. So just want to cover 2 additional risks and then we'll open it up for Q&A. And thank you for that explanation, Tony. I think that's super helpful and that really drives home the point. There are exceptionally more risks on expiration day. So it's important to manage those risks before you get there. That way it's not elevated. So it's extremely important to know. So something that's inherent with short calls is early assignment risk due to an ex-dividend date. So know, as a stockholder, you are entitled to the dividend only if you own the security the day before the ex date. So that means if you have a short call, you need to be aware of that. That's where pricing can vary and you are at risk of early assignment and it can be a surprise. Often it happens with SPY because they announce it the day before. So try to be aware of that. But this example is with MO. They had a dividend, and the way you do this is you look at it through the eyes of the long option holder. So you essentially just look at the price. So the intrinsic value of the option plus the dividend is greater than what is pricing, then you are more likely to be assigned, because it makes sense. You're entitled to the dividend at that place at that time. If you close out the option on the market, you're going to get less money. So that's why early assignment happens all too often, or a vast majority of the time, when there's a dividend in play. And so that's really important only on the day before the ex-dividend. When you're on the actual ex-dividend date, that it's already passed, they no longer qualify for it. So it doesn't matter. And then the last one, which can happen more with high beta securities, and this one is inherent if you have a short put or a short call. I like to call it surprise assignment, and you see a lot of disclosures coming up on brokerage firms about this now. But the example I used is Tesla, just because it moves a lot, and I've got this example back at the end of December, early January, when it did do a plop with overnight risk. So essentially, the OCC accepts instructions until 5:30 Eastern time, which is past the market close by an hour and a half. So if you are a long option holder, put or call, and you experience something like this, where you have, say, I have an example here of this moved around, the 1060 call. I've lost my trade. There we go. So you have the 1060 call, and Tesla closed at 1056.78. So that's that near the money example. You probably believe having the short call, I'm okay, that's not going to get called away. The long call holder says, man, I didn't make any money, this is the end of it. But all of a sudden something happens, and post market before 5:30 Eastern time, Tesla jumps up. The only thing that you can do as a long option holder is submit exercise instructions if your account can support it. So this is where you can get that surprise assignment. If you're the person who's randomly assigned, or first in first out assigned on the other end of it, is this post-market activity that caused you to be assigned. So that's why holding options into expiration always comes with assignment risk. And the only way to remove that assignment risk is by closing out those options. And because options only price in intrinsic value as you get to expiration, it's important to monitor that and do that early before you get to expiration day. So that really ties up the risks that I wanted to share with you.
And I'll just add to this last slide a little bit. It's not very common this happens, but there are a few notable examples here over the last couple of quarters. Not a lot of stocks report earnings after the close on a Friday, but a big one that recently moved was Nike. Nike reported. It normally reports on a Thursday, but reported for some reason last quarter on a Friday, and the stock jumped quite a bit after hours after the close on Friday. And a lot of short call holders got caught holding the bag, hoping, or basically on the close, thinking to themselves, my calls expired worthless, I don't have to worry about it. And the stock jumped after hours on earnings, and all of those calls were assigned on Monday morning. So be very careful if you choose to hold an option into expiration. The rule of thumb is always it's best to close it and avoid that obligation. But if you do have that obligation going into expiration Friday, just look at whether or not the option, the stock perhaps might report earnings after the close. It's not very common that happens, and Nike is certainly an example of a large stock that did it last quarter that normally we don't see very often with most large cap stocks. So that's just one example that I think comes to mind that some of you may have experienced actually last quarter. So with that covers what we wanted to share with you here today. I just want to end and leave you with the a huge thank you for everyone that has taken the time out here today to listen to Jess and I discuss exercise and assignment. Really important to understand these concepts for your trading. We talk a lot about strategy, we talk a lot about option pricing, but this is kind of some of the mechanics, if you will, of an option contract that is important as a trader, especially if you're new. You don't want to get caught out with these exercise and assignment risks. So hopefully today we illuminated that for you. And I just want to thank our members for supporting us and allowing us to continue providing this type of education here for you. For those of you that are new to OptionsPlay, I hope that you consider signing up for a free 30-day trial at OptionsPlay.com. You'll get access to our global macro research, our daily trading signals, as I showed you here before, as well as our longer term macro ideas that we send out to our customers. And just one other piece of housekeeping. We now have a mobile platform that you can download and access some of these educational sessions. You can point your phone at the QR code here on your screen. It'll have both iOS and Android options. So regardless of what kind of phone you have, pull out your phones, point it to that QR code, and you'll be able to download our latest mobile app. You'll be able to access our daily play research, our weekly macro research, as well as our educational sessions and a strategy constructor, all from your mobile platform. There's a lot more to come on that mobile platform. So hopefully you'll be able to download it and stay up to date. With that, what we'll do is we'll open this up for Q&A. There's both a Q&A window and a chat window here. So if you could please type your questions into the Q&A window, I'll try to answer as many questions as we have time for here today. The question regarding AM settlement, how do I tell if something is AM settled? Well, generally speaking, you'll see it on the expiration date. And again, if there's nothing on the expiration date, you can assume that it's PM settled. Usually the expiration dates that are AM settled will say AM next to the AM, next to the expiration date. Winston, your question regarding SPX not being listed in OptionsPlay, this really comes down to the costs to list those indices on the OptionsPlay platform. It's extremely expensive to offer those indices alone. And currently, we offer the NASDAQ 100 index options instead of the S&P 500 from a cost perspective. Are European options traded on the US markets? Yes, so European and American options aren't referring to the geographic region of where they're listed, it's referring to the type of option contracts. So yes, European options are listed on US option exchanges. It's just the type of contract, not where they are listed. I'm not sure I understand the question. Can you buy in the option if it's been assigned to you? If something's been assigned to you, you are either now long or short the stock. Mm-hmm. What is the advantage or disadvantage of index options for trading? There's quite a few advantages, I would say, to index options. One, they're cash settled, right? So you don't ever have to worry about exercise and assignment risk. It completely eliminates that. They are also potentially there's a potential tax benefit because they're Section 1264 contracts, similar to futures. You are taxed at 60% long-term capital gains, 40% short-term capital gains. So if you're thinking about choosing between the Qs or one of the NASDAQ 100 index options, if you're trading the same size, the index options provides that that additional tax advantage that you don't get when you're trading the Qs. As far as disadvantages, I would say that most index options are very large in contract size. Many times you're able to find option contracts that are more suited for your size for with an ETF. But most of the index options, like for example XND now, are sized even smaller than the QQQ ETF. So you can actually have more flexibility trading index options than you can with the Qs. So, those are some of the advantages and disadvantages. I wouldn't say one is significantly better than the other, but those are some of the differences between the contracts.
See one in there about the acquisition occurs, such as AMD acquiring XL and X. Long question there, but it sounds like an adjusted option. Tony and I were actually talking about that yesterday and decided since there's some big adjustments coming up, we'll probably host a session going over what that means. But normally, just in a nutshell, the best way to think about it, your contract represents 100 shares of deliverables. Whatever would happen to that 100 shares of deliverables is the way that your contract would be adjusted. So sometimes the strikes are adjusted, sometimes the deliverables are adjusted, which does require some algebra at some point. But if you ever want to find the terms of it, you can go to the OCC.com, go to the information memos, type in your underlying security, and it'll tell you exactly how to calculate everything that's there.
There's a question saying, can you elaborate why the long holder will lose extrinsic value 3 weeks prior to the long $100 call example? So, if you have a $100 call option and the stock is currently at 105 with 3 weeks left to go, that option is going to be worth $7, $8, $9. It's certainly going to be worth more than the $5 you're going to receive if you exercise the call option. So would you rather have $107 or would you rather have $105? I think we all know the answer to that question. So that's why you lose the extrinsic value of the option. So if you sell the option at $7 versus taking the $5 that you would receive if you exercise, that's the $2 that you're losing out. You're losing out on the $2 of extrinsic value. Whatever the extrinsic value is at that time, you are losing it if you choose to exercise rather than selling the call option. Are options ever exercised by a broker instead of the buyer? No, it's always the buyer that exercises a call or put option.
Auto exercise may occur though. So it's not the broker, it's really the OCC making that happen. But just know that it can happen without you initiating it, but it's automatically happening. And it's really to give you value. So that's the intent of it.
Yeah, because if your broker didn't auto exercise your call options at expiration that's in the money, you're effectively losing money. Or sorry, you're missing out on money that you could have had.
That's losing money for sure.
That's true. Aside from closing or rolling a short options position, is there any other way to avoid early assignment on a short in the money option? Besides closing or rolling it, I suppose you can buy in the money option that's further in the money and the two will offset each other, but I wouldn't recommend doing that. So I would say that closing and rolling a short options position is the only way to avoid early assignment.
What do I do if I get assigned and I don't have the money to carry the stock? Depends on the type of account that you have. But normally you can just offset the position. The settlements have to match up. So it's possible you get one of those trading violations depending on the account that you have. Definitely had one of those before. But if you are, if you're assigned and you buy the shares and you don't have the funds available, you can still immediately sell them. The purpose of the assignment, to Tony's point, is to make sure that you get the value that they have. So if you buy at 100 and the market's at 105, you could sell at 105 the following day on that Monday and offset that position. And that's how you would make yourself whole. The settlements won't match up, so you'll probably get a violation of some sort, but nonetheless, you offset the position.
Russell is asking, aren't the weekly options cash settled with no assignment? Russell, weekly options are no different than monthly options. So no, they are not cash settled. They are certainly have assignment risk. Weekly options are, again, no different than any other options and have the exact same risk profile.
Mm-hmm. Needing the cash on a naked put, you would if you were assigned, or the margin buying power. If you're naked, I'm assuming you have margin, which means you'll need the margin buying power in order to buy that security. Just watch out if you end up borrowing at that point.
Great question here. Can a short option that expires out of the money still be assigned? I.e., someone can choose to exercise the option even though it might be out of the money, because there's a BIB move might be coming soon after the expiration date. I'm not sure what BIB move is. Maybe you were talking about BIIB, which was a stock that gapped on an FDA approval about a year and a half ago after the close on Friday, if that's what you're referring to. The answer is absolutely yes. Just because a call option's out of the money does not mean someone can't choose to exercise it, and even if it doesn't move after hours, you can still technically choose to exercise an out of the money option. I wouldn't recommend it, but technically speaking, you can. So there's always the risk, and that's why we are suggesting that if you have a short call or put, whether it's a naked, cash secured, or a part of a spread, if you don't want that assignment risk, close out your position before expiration.
Mm-hmm. Greg asked a great question too for the Tesla trade we were showing on the screen. You sell a call and don't own the stock. Is that what they call being naked? Yes, because you're exposed to unlimited risk. That's really the reality of it. Because you have a short call, you are obligated to sell that security. And if you have an obligation to sell, theoretically, that underlying security can go to an infinite price. And if your obligation is kicked in, which it will when it goes to that infinite price, you have an unlimited loss potential. Therefore, have heavily risk exposed, and that's commonly referred to as naked exposure. So yes, you are naked on a short call if you don't have an offsetting long position, which could be in the form of shares or something that entitles you to buy stock like a long call.
Even if assignment deadline is at 5:30 p.m., isn't the assignment price determined by the closing price as of 4 p.m.? There's no such thing as an assignment price. There's a settlement price for cash settled indices. So if you're talking about a cash settled index, yes, it's based on the settlement price at 4 p.m. It doesn't matter for all intents and purposes, there is no such thing as an assignment on a cash settled index option. But there's no such thing as settlement on a physically settled option. Basically, if you are holding a short call or put into the close on expiration Friday, you are assuming the risk that you could be assigned after the close and that you are exposed based on where the market opens on that particular stock on Monday morning. So it doesn't really matter where the stock closes at 4 p.m. Can't you roll the spread? Yes. So rolling the spread is first closing the current spread and opening up a new one in a single order. But it's still, the first part of it is you have to close out the existing spread. So that's what we're trying to say, is that to avoid assignment and exercise risk, you have to close out your trade. Whether you choose to open up a new trade right immediately after that is up to you, but the first part is closing the trade. Do brokerage houses support automating these rules? I would say most major brokerage houses have some form of automation here already built into the rules that Jess was talking about, about auto assignment, do not exercise. Most brokerage firms have rules in place, but again, it depends on expiration Friday and how fast the market is moving, and how many accounts they have to manage on that particular day. It's a fairly manual process for brokerage houses to manage these things as you get closer to expiration. So you might find yourself, closed out on a trade prior to expiration because of some of these rules.
Mm-hmm. And if there's a lot, you're more likely, because they're not going to have an opportunity to reach out to you due to the manual nature. So they, just to remove risk, may enter a do not exercise. And I have seen some platforms where the internal systems literally have a button and can sell out everyone with a certain position. So that's something to be wary of, and in volatile situations, that risk is just heightened.
The answer is, do you close out every daily play 21 days before expiration? First of all, the 21-day rule only applies to credit spreads, and we'll always close out at least half the position somewhere around that 21 days to expiration. We may, if we close out half the position at a profit, choose to close the hold the remaining half to expiration to hopefully make 100% of the max gain. But that usually only happens if we've already closed out the first half at a pretty significant profit.
And yes, you can roll to prevent assignment. That's a form of closing out the option, and that's the only way to prevent it. If you close out that, if you roll out your option, yeah, you just have assignment risk for your new option, but it's not expiration day for that one, so you should be good to go.
Does your assignment risk expire at 5:30 p.m. Friday, or a news over the weekend trigger assignment on Monday? So in theory, I would say that your risk does expire at 5:30 p.m. So if something happens Monday morning, if you will, that's not at risk. But you don't know whether or not you've been assigned until Monday morning. So you're kind of in the dark as to whether or not that's happened. So that's why, again, I don't recommend it. If you're close to the price of the stock price that you're short, rule of thumb is close it out.
Mm-hmm.
Generally speaking, European style options are only cash settled index options that trade European. All other options, 99.99% of listed options in the US are American style. If I have a leap expiring in the money, do I have to close the contract to get the premium benefit, or will the profits automatically be given to me at expiration by the broker? So this is really what Jess was saying before. That depends, right? The best rule of thumb is to close it out so that you know for a fact that you're capturing the profits. In theory, those in the money options will be auto exercised, so you will collect the difference between the closing price and the strike price on Monday morning, or at least you have the stock that you now own with a profit based on that the price on Monday morning. But if, let's say, you don't have enough capital to exercise that leap, that's really where your broker could submit a do not exercise on your behalf to avoid a margin call. So there's the rule of thumb is, again, best practice is to close. That will avoid all of these edge scenarios that could cause you to miss out on some potential gains or take on additional risk.
Tony, do you have the registration link for your 8:45 tomorrow?
I will find that and post it into the chat link if you field a couple of questions in the meantime.
Sure. I did see a lot of questions about the recording. So they're posted to YouTube. And then I did see a couple about putting the sessions that we've done in the more linear order in a more consumable format on the website. So we'll make a YouTube playlist in the short term. And then in the long term, we're looking to put that together in a more comprehensive format on the website.
Right. So if you log on to the OptionsPlay platform, you will see a pop-up. If you can click on the notification button here on the upper right-hand corner. And if you go to the second pop-up, Daily Masterclass, there is a link here to register. This is a class that is limited to just members here at OptionsPlay. So if you're a member, you can log on. If you don't have a membership, once again, you can sign up for a free trial at optionsplay.com. And that will give you access to the session here tomorrow morning.
I put it in the chat.
If I buy an option and want to convert it to stocks, do I call the broker, or can that be done on the platform like Thinkorswim? Both, at least for Thinkorswim, you can do it on both. You can do it by calling, or you can do it online. Not every broker supports, exercising it through an online request. Some require you to call. So it depends on your broker.
That it does. Where can I find the stocks ex-dividend date? I believe that one's on the OptionsPlay platform as well. But on your broker site, normally the security profile will always have that.
Once an option has been assigned to you, do you have alternatives to assignment? No. Once it's been assigned to you, that's it. You are now long or short the stock. You can choose to close out that stock position immediately and reduce your exposure, but there's not much you can do beyond that. If I hold an option expiring in 3 weeks, am I exposed to gamma risk given the price is near the money? So Jamie, gamma risk is highest as you get closer and closer to expiration, especially if the stock price is, if the strike price is close to the current price of the stock. So that's part of why we avoid selling credit spreads in the last 2 to 3 weeks, because that's really where you have the highest gamma risk. And we tend to find that the threshold between gamma risk versus the acceleration that you get in theta decay, that crossover where gamma risk no longer makes any sense for the acceleration that you get in theta happens at around 3 weeks or so. And that's why the rule of thumb to close out a credit spread at 21 days to expiration is there. But it also serves the purpose of removing assignment risk on a credit spread. So it serves dual purposes, that 21-day rule.
And Chandon, as a member, you do automatically get registered for all of our webinars, and you'll get reminders in your email box.
Yeah, that's a good point. If you're a member or if you're on a free trial, you will automatically be registered for the session here tomorrow morning at 8:45 with me and Rick. But if you want to register, you can always log on to your platform and you'll be able to see the pop-up. When a platform says I'm rolling for credit, does it take into consideration what has been lost already on the option being rolled? It doesn't take into account your profit and loss. It takes into account what you have to pay to get out of the previous spread and what you're collecting on the new spread. The net difference between those two is what the platform is really telling you when it tells you you're trading the roll at a net credit or a net debit. It doesn't account for whether you made money or lost money on the previous trade. And with that, I think that covers the questions that we have time for here today. And I just want to say, again, a huge thank you for those of you who are attending and coming to our sessions every single week, learning more about options, improving your knowledge of options. I hope that this is helpful in giving you a better understanding of a piece of the option contract that we don't talk about a lot, but is really important to the well-being of your portfolio, if you will. And I want to say a huge thank you again to Jess for putting together this presentation today and giving you a strong deep dive, if you will, into exercise and assignment. So with that, thank you so much. Have a great afternoon. I'll see you bright and early tomorrow morning.
Thank you so much.